In this episode, we speak with Brendan Carroll, co-founder and senior partner at Victory Park Capital, a global leader in alternative asset management specializing in private asset-backed credit. Founded in 2007 and now a majority-owned affiliate of Janus Henderson Group, VPC offers comprehensive financing and capital market solutions through its affiliate platform, Triumph Capital Markets. With a global presence across 25 cities, VPC is at the forefront of innovative investment strategies. Brendan leads strategic initiatives, firm operations, and the sourcing of high-impact investment opportunities at VPC. As a key member of the firm's investment and valuation committees, Brendan's leadership is integral to driving the firm's success and delivering exceptional value to its investors. I'm your host, RJ Lumba. We hope you enjoy the show. If you like the episode, click to follow.
RJ Lumba is the managing partner of Growth Cap and the executive chairman of Market Insight Media. He is the host of Growth Investor, a podcast featuring today's best investors, executives, and founders. In the minutes ahead, we'll uncover insights and strategies for accelerating growth and succeeding in business.
Brendan, thank you so much for taking the time. It's a delight to be with you.
RJ, nice to see you again.
Yeah, as we were kind of chatting before the recording started, we were reminiscing about folks we know and in old times, going all the way back 2 decades probably. But it's been wonderful to kind of see how your career has progressed and where you sit now. You're entrepreneurial and starting Victory Park. Maybe for the benefit of our audience, because our audience leans towards, equity, private equity. I'm sure they've heard of Victory Park, but maybe to set the stage, tell us about your firm.
Sure. So Victory Park, founded by myself and my partner, Richard Levy. We've been around since 2007. Richard and I had worked previously at Magnetar Capital, and we left and set up Victory Park with a simple thesis of looking to provide private credit, asset-backed credit anywhere a bank wasn't. And we closed on our first fund in June of 2008, so about 45 days before Lehman Brothers collapsed, which obviously changed the world quite a bit in terms of who was actually providing credit, but also who needed it. And we started to see an opportunity to provide capital to businesses that historically were able to access the securitization markets maybe a bit earlier or more traditional bank lines and loans. We are providing credit facilities that are based upon actual assets, whether it's inventory, receivables, a pool of consumer loans, real estate, whatever it may be, something that you can look, touch, and feel and value. And sponsors and the equity holders that we all know from an institutional basis around the world are typically the investors or owners of the businesses we lend to, but it's not sponsor debt. We're not financing buyouts or dividend recaps or anything like that. And it's not venture debt. We're not lending against enterprise value or things of that nature. We are lending to businesses that need debt as part of their business model. And the borrower's ultimate goal is to show the traditional bank model securitization markets that they can scale, get a securitization done, et cetera. So we're helping them sort of fill that void or cross that chasm until they can get to that more traditional institutional debt round.
Mm-hmm. Was there a gap in the market, which is what prompted you to start Victory Park? Was it obvious, okay, with you and your co-founder, we should go after this segment?
We had decided when we left Magnetar, we had decided we were going to, have a private credit focus and private credit strategy. It definitely did not predict the global financial crisis. So when we went into it, it was more, call it special situation type lending around maybe a catalyst or a restructuring or something of that nature. And then with the global financial crisis, that created 2 massive catalysts. 1, dramatic pullback in capital, but 2, it began what I think is one of the largest inflows of growth equity venture capital to build businesses and platforms to fill the void created by the banks. And thankfully, from our fellow employer back in the day, Robertson Stevens, the alumni network, as we're seeing here today, goes far and wide. So I started getting phone calls from some of our former colleagues in the venture world who were starting new businesses to provide lending or transaction services, payment processing, what have you. And there was no way they were getting a traditional bank to help finance that balance sheet. So we started to see more and more of this. And then, fast forward now, almost 19 years, we've deployed about 12 billion or so, around 250 deals around the world with that same thesis, right? We're not lending to a distressed business and we're not lending to a buyout. We're just providing capital to businesses that need debt on their balance sheet. But whether it's because where they are in their life as a business, or it's a new product or service, or you got a higher rate environment like we do right now. Capital markets or banks don't make sense, and we sort of step in. So we've seen the opportunity be very consistent, really, since that beginning of the global financial crisis.
Mm-hmm. And you play in certain lanes, it seems like. Maybe there's like a handful, like it's like legal seems to be one area. Can you tell us about that?
Yeah, I mean, that type of strategy in debt only makes sense for certain business models, right? We're not lending to software companies, or we don't do anything within biotech or healthcare. It's a lot within receivables financing, financial services, consumer, small business, et cetera. And then that sort of flowed into seeing opportunity again under that same thesis. We're going to lend money where banks won't. We started to see opportunities within what we call legal finance, whether it's lending money directly to a law firm where, again, we're looking at case files or case loads as inventory, no different than we would look at, a typical receivable or any other sort of inventory. We just obviously are going to value it a bit differently. Or, backing platforms that are providing some sort of financing to the legal community in the US. Because again, for the most part, banks just don't really lend to those smaller law firms. And without the ability for traditional equity investors to own law firms, Arizona is now the first state where you can do it. It's just an inefficient market in terms of financing. So we kind of came upon it about a decade ago, became bullish on it, and built out a pretty large team and have about $1.25 billion of exposure, which is pretty hard to do considering it's very fragmented. It's not like you can put the capital out in $50-100 million chunks. So it's been built up over time, but we're very bullish on it. Recession resistant, it's uncorrelated. And again, I don't see the banks coming in to replace that type of financing anytime soon.
And then tell us a little bit about the genesis of the relationship with Janus and kind of why you decided to pursue that. I don't know how common it is. From my perspective, maybe it's not as common, like a private credit group to partner up in that fashion. But I'm not as familiar with.
No, sure. This. And it's funny because prior to going through this process, my main exposure to Janus Henderson was when we were at Robbie Stevens together and I was doing IPO roadshows. And you always had to go through Denver to see Janus. But we sold 25% of our business back in 2018 to Pacific Current, they're a public company based in Australia. And then they announced publicly, maybe 2 years ago, I may be a little off on the timing, that they had retained UBS to explore strategic options. And fast forward now to today, they lifted out a bunch of their team at Pacific Current to go in-house at one of their other fund investments that they'd made. So when they did that, and we had a great experience with Pacific Current, and they're still a shareholder, so we still work with them, that just kind of made us look around and say, okay, in a perfect world, what would be the best catalyst for our business? And I had met Ali Dabaj, the CEO of Janus Henderson, when he was the CFO at AllianceBernstein, along with his head of strategy, Suk Grewal. And we'd had conversations with Alliance in the past. So I walked in and got on a Zoom and I saw Ali and Suk on the screen. And I was looking at my schedule and I said, I thought we were having a Zoom with Janus Henderson. That's AllianceBernstein. And he laughed. He goes, no, I got a new job. So we'd had a previous relationship and I liked him. And then the more myself, Richard, my other partners, and really the whole firm got to know Ali, Suk, and everybody else at Janus Henderson and understand what Ali and his leadership was trying to build and change. He's been there now a little over 2 years, 2.5 years. There was an alignment, right? They've been around for a very long time and have a significant amount of expertise and assets within traditional fixed income, CLOs, a lot more of the liquid side of debt, so to say, but they didn't have any privates. And, right time, right place made sense, culture fit, alignment in terms of the distribution, our ability to now offer different types of products, interval funds, evergreen funds, Luxembourg SARLs, Aussie Unit Trust, right? For us, it doesn't change how we find, execute, or manage investments. But from a distribution standpoint, they have distribution offices all over the world. But just as important as being able to go to Europe, Asia, et cetera, and get introduced to their client base, the ability to have the infrastructure to create the right type of fund and wrapper for that specific region of the world or that specific type of investor was extremely important to us, right? We've done a nice job on our own of doing your traditional drawdown funds as well as with insurance companies doing rated feeder vehicles. But for all the other different types of structures, wants, and needs that the institutional investor community wants to access private credit, we needed a partner and we needed help. So we were very excited about that. We're keeping our brand. And that wasn't because of my ego or Richard's ego. It was Ali agreed that in the industries where we are active on the investment side, we've built a brand over the past 2 decades, and that's important. So it's not changing how we operate day to day. We didn't reduce headcount or anything along those lines. If anything, and we've actually grown. The main change has really just been plugging into their infrastructure and their distribution channel. And I think you and I have had to reschedule this a few times because I've been on planes all over the world. But they've been great. And, it's May already. We closed it in October. So it feels like it's been longer, but so far, so good.
Now, does this play into also access to the retail investor? I know that's a big thing happening across alternatives.
We haven't changed the type of lending we do going back to '07. But what has certainly changed is who's got interest in the asset class. And we see that change every few years. Like initially, what we did made no sense in most traditional asset allocation models, right? If I went to go see a pension fund or a consultant, yeah, maybe 1 or 2 of them along the line had some sort of illiquid portion of a fixed income bucket. For the most part, though, private credit didn't really exist. Or if it did, it was your more traditional direct lending, sponsor-backed cash flow lending, things of that nature. Interest rates stay at zero for a long enough time. And then obviously people have to start looking for yield elsewhere. That leads to then more traditional institutions, then insurance companies. Fast forward now, you're seeing, the RIA channel and the high net worth channel want to access it. And again, there's ways to do it where it makes sense, but we alone, didn't necessarily have the infrastructure to do that. It is public. I'm allowed to say that we filed, I think it was 2 days ago, for our first interval fund product in conjunction with Janus Henderson. Janus Henderson also owns a majority of a company called Privacore, which is an expert and manages interval funds. So this is the first joint product that we are launching with Janus. Again, it doesn't change how we're lending or anything along those lines, but we're seeing a lot of demand from that RIA and private wealth channel. And again, our business is pretty simple. We're trying to convince companies to take our money, and we're trying to convince investors to trust us with their money. On both sides, we're going to try to do whatever we can to meet those needs. And you're seeing more and more demand, like you just said. So this is why we're approaching it. Now, thankfully, for what we do within private credit, it makes sense. We've had some larger managed accounts where that sort of structure already exists, but this is obviously different in terms of that it's a formal interval fund where we've filed with the SEC and now we're in the quiet period. So I think that's all I'm really allowed to say about it. But yeah, that's the first product we've launched with Janus.
And I think for our kind of general audience, like what you're describing and what you focus on will sound very specific. And so begs the question, like, are you one of a kind? I mean, there's probably others that do what you're doing, but how competitive is your particular space?
I mean, when I'm trying to convince a company to take our debt capital versus others, the over under, call it 100 million in loan size, under 100 million, I'm running in to a different set of competitors than I'm seeing when I go above 100 million. And typically you don't see those people crossing over. So I think what's differentiated about us, one, this is all we've done, right? This asset-backed lending isn't something we're getting into because it's become more popular. This is all we've ever done. So I think our brand and reputation helps in that way. Two, just the way that we operate as a firm, most of our loans are delayed draw term loans, right? So if I commit $200 million to your business, what you draw on day one is dependent upon the value of the collateral I'm lending against. So maybe you're only drawing 40, 50 million. And then over the next 2, 3, 4 years, as you're adding more collateral to your balance sheet, you're coming and drawing more. So our exposure grows over time, but it's not a one-time funding, right? It's not a transaction, so to say. We're not relying upon M&A volume to put capital out the door. So at any given time, you're going to have a portfolio of borrowers, per se, from Victory Park. So while, yes, we have fund vintages, because if we raise a fund in a certain year, then that's technically a vintage. But we'll have companies that are borrowers of Victory Park over multiple funds or multiple vehicles because they're just remaining a borrower with us. So what I think that allows us to do in any kind of structure is we can show with pretty good transparency, hey, here's who the 20 names that are in our portfolio right now. Here's how they've performed. You can take a look and see at the investment committee memos, the risk reports, et cetera. It's not your traditional where, okay, we raised 2.6 billion in our last fund. We made 32 loans, and now we're going out and raising a new fund. I got to go find 32 new loans again. It's not how it works, right? And I'd like to tell you that was part of the reasoning when we started the business, but the delayed draw term structure and that making sense for our borrowers, that really allows us to provide transparency and to do different types of fund structures. Because if I had to go out and find brand new deals every time we raised a new fund, then there's only certain structures that would probably work. So I think what differentiates us is that we've been doing this a long time. We are originating everything that goes into our funds. We're not buying paper on the open market. We're not doing syndicated loan transactions or things of that nature. Everything that we do is sourced, structured, negotiated, and managed between us and the borrower directly.
Now, with the rising tide of private credit, have your kind of like ambitions or collectively the objectives of your partnership team, has that also kind of grown? I mean, it seems like, private credit is having its moment.
I jokingly say people have been asking me two questions since 2007. Are you fundraising right now? And is it competitive? And the answer has been yes to both since 2007. What changes, though, is maybe who you're competing against or, the size of company or type of company you're lending to. So, for example, if you look pre-COVID, our average loan exposure to a company was around 80 million, right? Based on that delayed draw term structure I just mentioned. If you look at it right now, it's about 135, 140 million. Now, we're not lending to different businesses. We haven't changed what we're doing, but in this current macro environment, maybe that business when rates were at zero could refinance us in 3 years, but now it's taken 5 or 6. So they're staying with us longer. So the exposure is larger. And so, you're not changing who you lend to or how you do it, but the exposures are becoming larger just because there's less places within both private credit and the banking world to find that debt capital. The thing that really changes with us in the Janus Henderson transaction is they obviously have expertise within more liquid fixed income products. Now we have the ability, in theory, to go to one of our large clients or one of their large clients and say, hey, if you'd like to have 2/3 of your capital in liquid fixed income, but now transition 1/3 in the privates and then kind of toggle back and forth over time as you see the market shifting. We couldn't do that before, right? We weren't set up from a talent perspective to manage liquid fixed income portfolios, nor would we be able to compete in that market. Now with an established partner, again, it's not changing how we're lending to our portfolio companies, but it gives us more ability to meet, the needs and wants of our LP base.
We're coming up on time. I have two final questions. Before I ask the two final ones, I'm curious, when you were growing up, if you were to think back, obviously we met at Robbie, which was, in our 20s, but if you were going to go back even further, did you show entrepreneurial signs? Because, you're while you are in finance, right, you're also, kind of an entrepreneur, co-founding Victory Park. Would you have extrapolated out from when you were a kid to where you are now?
That's a good question. I mean, in college, I worked in politics. I worked for Senator Joe Lieberman, who was the chairman of Victory Park from the day he retired from the Senate to the day he unfortunately passed away. So no, until I stepped foot in Robertson Stevens, I thought I was going to work in politics and work for the government, work for Senator Lieberman because I loved it. Now, it's a different type of entrepreneurial spirit, or I jokingly say we're all in sales in some way, shape, or form. And I did learn pretty early on in college in that environment. But no, I jokingly tell my kids, I'm still trying to figure out what I want to do for a living. So take every opportunity that you see. The day before Richard and I decided to start Victory Park, I had no idea that we were going to start Victory Park. So the short answer is no, I had no idea. And I don't think I would change it. I worked in politics. I worked on 2 presidential campaigns, and then I joined you at Robbie right out of college. And it's so funny when you look at it today, there's no way I'd get a job in an investment bank today. There's no way. I had zero finance classes in college. I was in the College of Arts and Sciences at Georgetown. I had a very good liberal arts education, but I had zero experience. You look today, these students, they're way more qualified. They're double majored in finance and accounting. By the time we've even looked at a resume, they've had 3 internships at top tier financial services firms. I was just lucky, I guess, because it was 1999. It was the internet boom and the investment banking world needed to staff up. So that worked out in my favor, your favor, and a lot of our friends' favor. But no, I'm still take every opportunity as it comes. If you had asked me 2 years ago, would we be a part of the Janus Henderson family, I would have said, no way. I have no idea. So that's the part that keeps it interesting and fun.
Excellent. Last 2 questions. Can you tell us about a person who has had a profound influence on you?
Sure. I mentioned it, Joe Lieberman. Outside of my father, who passed away back in 2020, from a work standpoint, I worked with Joe Lieberman on and off since I was 19 years old. I was his body man, so to say. If you've ever watched The West Wing, I was Charlie, right? So I was the kid who could be with him at all times, travel with him, etc. I was spoiled because everything you hear about politics today is nothing that I experienced when I worked for him. He was one of the most high integrity, high intelligence human beings I've ever encountered, and treated everybody the same, whether we were in the White House or he's just walking down the street. And just everything I learned from him in terms of diplomacy, trying to remain calm under pressure, things of that nature. And we were very fortunate, everyone here at Victory Park, that he came and for 12 years or so served as our chairman. And when he joined, obviously he did not have much experience in, forget private credit, but just alternative investment world in general. But again, high integrity, high IQ usually help. And he got up to speed very quickly and was an integral part of this firm and its growth, both as a moral compass and just a good source of advice whenever we needed it. So can't say enough about him. We miss him dearly. If you ever come in our office here in Chicago, there's a great mural of him on the wall. Unfortunately, I met him through my father when I was a little kid. So I'm going to go with Joe Lieberman on that one.
Fantastic. Last question. Can you tell us about a charity, cause, or other endeavor that you're passionate about?
Sure. So my youngest son is a cancer survivor twice. He had what's known as Wilms tumor. So when he was 6 weeks old, a combination of my wife's mother's intuition and her medical training, because she was a nurse, figured out that there was something off. And, long story short, they found a tumor in his kidney and had to take the kidney out, take the tumor out. It's a very rare type of cancer. And even when it does present, it usually isn't in someone that small. So they didn't really have the playbook, so to say. So for the first, call it, 3 years of his life, he spent most of his time in the hospital getting treatment because it went away, then it came back. And then, knock on wood, he turns 13 on Friday of this week. So my wife and I have a foundation that supports pediatric cancer services and research, primarily here in Chicago, Lurie Children's Hospital. That's our biggest passion.
Wonderful. Well, Brendan, I want to thank you again for taking the time. This has been an awesome conversation.
Thanks, RJ. Great to see you. Thanks for your time.